So do you actually see my pop-up as well? The option, the window where it's showing all the option pricing?
Right now, I just see the my account screen. That's all I can see.
Okay, so let me share my full screen. Can you guys see my? Can you see my pop-up window now?
Not yet, Asti. Yeah, now yes.
Okay, so I'll go back. So here, so there are various ways you can actually do the trading. I'm going to just show you one way right now, then I'll show you other ways as well, at least in the Ameritrade platform. So when you hover on this here, it's showing the what is the current price and trends. There is an option chain here, right? So when you click on that, so it's going to open a window with the details. So it kind of shows you in the straddle view. So here you can see options. These are monthly options. You can see that these options are expiring every month. The one coming up next week, October 15th, and next November 19th. So as mentioned in earlier session, these monthlies expire every third Friday. So 15th is the third Friday of this month. So you can see that there are options expiring. So we can actually trade either October 15th or November 19th. Since it's only one more week, option premiums are going to be very less. I'm going to just pick November 19th. So the current stock price is 27.11. That's the bid right now. And as showed earlier, or you can show it again here, the price we got it for 27.51. So I want to sell my stock for more than 27, like more than, sorry, my cost is 31. So I want, current price is 27.51. So I want to sell my option for a price above $31. So in that case, what I'll do is I'll go to November, right? And you can see since we are doing a covered call here, you can see all the prices for various strike prices, right? So you can see from 22 all the way to 35. You can actually, these are the near the money, meaning, so these are the based on the current market price. It's showing all the ones that are close by to the current market price. In this case, the current market price is 27.51. So it's showing 25.50, 22.50, and 3 above the market price, right? So because I bought it for $31, I'm okay to sell it for a little profit, at least maybe 100 of those, right? So what I'll do is here, so I'm going to pick the 32.51. And you can see that bid and ask are 45 cents and 60 cents. Bid is what the price that the buyers are willing to pay, right? And right now there are sellers who are willing to sell it for 60, right? So when I want to sell something, I'm going to put somewhere in between because right now the bid and ask spread is a little bit more because it's after hours. But usually, depending on the stock volatility and other factors, volume, the spread will be low, right? So you always want to make sure you are not selling just for the bid, at least a few cents or whatever is your comfortable level is, right? So in this case, I'm okay selling at say 55 cents, right? I'm going to just click on this. So in case of Ameriprice, it will automatically populate this information saying that I'm ready, like sell to open, and I'm okay to sell one contract, that is 32.50, and I am okay to sell at 55 cents, the limit price. And I'm saying the time in force is day for now. I usually just do day for the options. I don't do GTC good till cancel. And then you can, so in this case, if I'm putting 55 cents means my effective sell price here is 32.5 plus 55, right? It's $33.05. And I got it for 31, and I'm just selling it for 33 if the price goes to 33 or 32.50 by November 19th. So I'm going to only sell one contract. That means I'm only playing with 100 stock, right? That means if I happen to get assigned at that time, my stock quantity is going to be reduced by 100. So it will become 2131. So you can see that sell to open one contract, CPNG, limited 55, estimated amount, because this is the amount they're going to credit. And there is a commission for this option. So there are some options where you don't get charged. Usually when you write the put option, sell the put option, but in this case, we're getting a charge of 65 cents as a commission. So your account will be credited with this amount, $54.35. So you just simply place the order. Right, we place the order here. So if you go back to the positions and I open that. I don't know if the market, they're actually submitting the orders to the exchange. Yeah, they're not submitting the exchange. Otherwise, our price would have showed up here 55 cents. So when I'm putting the price, I'm looking at a few other things. You can see also the last price at which it was executed. It was executed at 50, right? It's anyway above 45. So if you're placing a covered call, make sure you look at the last execute price as well. Again, it depends. If the market moves quickly, this may become irrelevant, but most of the time you should check so that you're trying to figure out what's the good price to put at. So now that we place the order, so if I go to my order status, it's open. So tomorrow morning, it will get executed if it actually hits that, right? Tomorrow, even if it goes up a little bit, most likely it will get executed. So that's one way to do this. Other way would be like you can actually go to like if you're an advanced user. The TD Ameritrade actually provides you various ways to do it. One is to using that Ameritrade platform, or you can use ThinkSabio. So even within TD Ameritrade, I showed you one way of doing it. I'm going to show you other way. So you can go to trade and options. So here you can choose, okay, single order, covered call, various options here. So I can do covered call and I can say, if I want to place one more order for one more contract, I can click there and I can click on option chain. So it kind of shows you just that call information by strike. So in this case, we said we are going to do the 32.51. November. Yeah, something is wrong here. Yeah, here you can just go and select this again. And it fills all the information here. So then you can see how much quantity you want to buy or sell. Oh, so we actually selected the ask price. So you can enter one here and you can say sell to open. Oh, sorry. So this one is actually, you can actually execute a strategy where you're actually buying the stock as well as option at the same, meaning at the same time, you're actually selling the option as well. So let's clear that, trade options. You just do sell to open, one contract, expiration is November 19, strike price I want to do 32.50. I want to sell a call. Kind of shows you what's the current bid and the ask price are. So you can decide what price you want to put at. So we did 55 for the other one. I will say 60 for this one. Right, and you can review the order. So sell to open, limited 60 cents, time in force. So you can place the order. Right, I placed two orders, one for 55 cents and one for 60 cents. So if both of them get executed, I'm pretty much writing a contract saying that I'll give away 200 stock total, one for one where I got 55 cents and for the other I'm getting 60 cents. Okay, so couple of other things I quickly want to show you, and a lot of discussion around straddles and strangles. So you can actually execute them right here. You can actually put a option chain, whichever you want to do, like A, B, and B. So you can actually directly trade the advanced strategies here. So one thing to remember is, so there is credit transactions and debit transactions. So credit transactions are where your account is getting credited with amount. That means you are selling something. So debit transaction means you are actually spending money overall on the overall transactions. Because with this option strategy, you can have complicated strategy where you can have like 3 or 4 legs, like starting with 2 legs, you can go up to 8 legs, depending on what kind of strategy you have, right? Overall strategy could be either a debit transaction or a credit transaction. So that's what you kind of see here. You can see whether it's a net debit transaction or net credit transaction. So since here we are saying buy to open, so that means that we're buying a straddle here, right? So it would be a net debit. But if I say, if I'm actually selling a straddle, then it will be a net credit. You will be credited with the amount, whatever is the amount for that strategy is. But just remember, when you're selling, you are making money right away, but there are, the maximum money you can make is whatever is the credit money you got right away, but the maximum loss is dependent on the strategy you have executed. All right. So if you're using Thinkorswim platform, it kind of, it's the same account actually. I logged into Thinkorswim. So it has much more advanced views. So if you're an advanced trader, once you get used to trading using the simple approach that I was showing, you can actually get into the Thinkorswim. You can either do it from the web, or they also, I recommend actually you download their standalone app. And you can run it and you can actually trade it from there. So they have nice graphs. If you're used to seeing some of the graphs with the options, nice graphs, and you can actually get a lot more data. All right, that's all I have to cover. Maybe we can start taking questions, and then I can go over if somebody has a question, and if somebody wants me to show how I can do this. So we can actually go through that scenario and then see if it helps to understand the scenario.
Yeah. Okay, Asti, in that case, anybody has questions, please raise your hand so it's easy. The way we understand you want to talk. Let me open it. Srini.
Thank you, Hasti. And would you mind explaining you explained options earlier, covered calls also. So would you mind explaining straddle a little bit?
Yeah, so definitely. So straddle concept is just like a horse straddle, right? You're sitting on a straddle, you're putting both your legs on both sides, right? So you kind of pick a stock price. So let's take a simple example. So let's go back to my positions here. So I have an Airbnb here, right? So I'm going to choose a stock option. Say, so one other thing is some of the stocks will have weekly expiries and some will have both. So in this case, Airbnb has weeklies as well as monthlies. You can see if there is a weekly written, that means there is an option that's expiring every week. Say for example, right now the stock is trading at 170, correct? And next week there is a news or they have earnings coming out. And if I suspect that it might jump, either it might go down or go up rapidly, right? So you want to take advantage of the movement on either side, right? So in that case, what I would do is, for example, I would say, okay, so current market price is 7. You can actually write the straddle at any price. Usually, you would try to write it at the current price so that any movement, drastic movement from the current market price, you can take advantage of, right? So here, for example, 170 call. So if I want to buy a call, so in this case, I'm going to just do it as a buyer of the straddle. So I would be buying a call as well as put for the same price, meaning sorry, for the same strike price, right? So if I want to buy, you can see that there is an ask price of 340 and ask price of 390, right? So if I add those up, so the total cost is going to be $7.30. So what we can actually do is, so here if we are trying to do it individually, a call and a put, but all these platforms nowadays, actually they provide you a nice way of clubbing them together, and you can actually trade them as one. So you can see that 170 call is, so they're still showing the puts here and calls here and the puts here. And it's showing the straddle price as well, right? Since I'm going long at 170, so there is a bid price of 695, and just like with some 340 and the 390, so the ask price is 730. So I can just say that I want to go ahead and buy this straddle. So what does that mean, right? So if there is a drastic movement of price from 170 to say 165 or 175 or way low, right? You're going to make money. So ideally, so if we take out all the other factors, volatility, time, the other factors that are included in the price, the purely, if we do by intrinsic value, we are spending $7.30, right? If it goes below, if we take out 730 from 160, it's going to be 160 to 70. You are making money as an intrinsic value, right? And if it goes above 177.30, you're going to make money. But it doesn't really have to go that high or low, because there will be other factors so that influence the actual option price, depending on the time to expiry, volatility, and other things. So if there is a sudden movement, you'll make money. So in this case, you're expecting a drastic move. So you can just go ahead and buy this straddle, right? I can just click this. So I'm going to execute this as a straddle, right? Here you can see it's a net debit. That means I'm actually paying $7.30 for buying both put and a call for 170 strike price. Okay. So you can just review the order and then you need to put how many contracts you want to buy, of course. So 730 means it's a debit. So you're paying $7.30. So it's a minus 730, right? So I can go ahead and review, and then I can place the order.
So Asti, I'm not sure if the ThinkSabio got his answer. So what is the max loss? $730 is the max loss, right?
Yes. So if you let this contract completely expire without taking action before expiry, as the maximum loss is 730.
Okay.
But for any reason, say, so tomorrow is a Airbnb the earnings, right? And you got this straddle, and they just met the analysts' estimates, and it's not moving anywhere, just stuck there, right? Meaning this value of this straddle is going to go down to say $300, right? And straddle is expiring next week, so you can wait till next week and lose all the value. If you think there is a chance that some other news might come between now and then, that might make the stock to move drastically in one direction or the other. Or you can just close it and just take the loss of $400. But if you just leave it till the expiry and you didn't want to close, then the maximum loss is going to be 731. It's fixed.
Okay. So, I mean, based on the chart questions, I'm trying to put it so it is simple for communication. So max loss is 730, whereas the max gain can be how the direction of the stock it takes, in either of the directions, basically, right? If it moves extremely volatile, if it makes extremely volatile move in any direction, we make on one side and we lose on the other side, basically.
So that's correct. So let's take a case. So stock is 170 today, right? And the earnings came out and they beat the hell out of the earnings, right? Meaning they showed the earnings twice and the market went crazy and the stock went up to $250, right? So call the intrinsic value itself, it went to $250. That means there is $80 in intrinsic value, right? So you're pretty much gaining $80 from the call side. And the put, yeah, there is like, what was the cost of the put? Like if you go back, so the put is around 390, right? So you're going to just lose the 390 because the put is going to lose the value. So 390, so you're going to subtract 390 from the $80. So it's around, so $76 profit. If a stock suddenly moves up, right? And it's the same case for if suddenly the stock goes down to, say, for example, they didn't do well and they didn't give proper guidance for the upcoming quarters, and stock went down to, say, $140, right? That's a $30 move. Yeah, so then you're going to make $30 minus whatever is the call prices, because the call is going to lose value, right? Pretty much. It may not lose completely, but you can close the straddle. You might still have some value in it. But again, that's the max side of things. So it doesn't mean that if the stock goes to, say, suddenly to 163, the overall straddle value might still be above what you paid for. You might make just $100, $200.
Right. Okay.
So which is what most of the traders do, this straddle right around some events and other things so that they can make quick money, right? So they're not looking for thousands of dollars, usually even $400, $500 on this straddle. It's a good quick money, like whenever there is a the event.
Okay. Yeah.
But yeah, sometimes you can get lucky, and then you can hit the jackpot where it jumps huge on either direction.
Okay. So another question is like within this, right? You executed both together. Now, if the call is up or one direction, let's think one direction is up, and the worst case is it sat at the same place. $2 move both sides, it doesn't help, and both premiums will be wasted. But let's say it took one direction. Can we close one? How do we do that? That's another question.
Yeah. So once this stock gets executed, like in your portfolio, it's going to show up as two different options.
Okay.
So you can actually close one if you want.
Okay.
And then or you can just go to the screen and then close them using the straddle strategy itself, because it knows that you have this underlying position. When the straddle gets executed, it's going to close your position.
Got it. Yeah, I'm covering most of the questions which are asked in chat. So hope it is answering. Otherwise, you can still raise your hand and get that answers.
So to Dhanu's prior question, right? Say, for example, earnings came in, they're not too good, but they met the expectation. The stock, it went down by just by $2, right? Meaning you lost a little bit of money on the call. So what you could do is your put actually went up a little bit. So in that case, you can just close your put and make a profit on that. But you're making an assumption that there might be some other news that come up that will help you move in your direction. So once you have this straddle, you can actually play with it quite a bit in the sense, for example, once a straddle enters into profit, sometimes you enter into profit because there's a big move on one side. You can close the other leg that's in loss for maybe it's, say, for example, it went to 162 and your put is almost $8. Now your call is only 10 cents, right? You can go ahead and close the put and make the profit, but leave the call just in case next 4 or 5 days, who knows what happens, right? It might again bounce back, right? So just leave it there, just losing 10 cents because you already made the profit on the overall trade. So you don't need to close the full straddle.
Got it.
So that way you can make money just in case things work your way.
Okay. So this is not just my question, what I have. So how is it different than opening just regular put and regular call?
It's under the covers, it's not no different. It's doing the same job, right?
Got it. Yeah.
But it's the trading, like these trading platforms are helping you to kind of view it from the strategy perspective.
Got it.
And nowadays there are even the CME marketplaces where they let you actually trade it as a straddle, meaning but at the end of the day, if you look at it, right? So as I was showing earlier, so if you actually sum up the ask and bid, that's the same price you actually see it on the straddle ask price as well.
Got it. Yeah. I covered a few questions, Asti. Let me allow next person. Good stuff. Abhi.
Hey, Srini, can you hear me?
Yes, I can.
Yes, we can hear.
Hey, Srini, yeah. Okay, this is regarding the covered calls that you covered earlier. Can you go back to the order that you placed? Okay, so let's take one of them, the 55 cents. That's good. So tomorrow, on what basis will this order get executed? At what point? I mean, you put in sell to open, and you have a 55 cents, which is $55 from your end, and you're saying you want to sell 100 shares at 32.50 per share.
Right.
So at what point will this get sold, and when it gets sold, how much are you making and how much are you losing?
Okay, so I just want to disclose one thing. I never place options order outside the market hours. I just want to let you know, guys, right? So,
Correct.
Say for example, in the morning, so let's say I left this order tonight, right?
Correct.
So these prices are based on today's market closing prices, right? This bid and ask are the end of the day prices, right? So tomorrow morning, because options are not trading pre and post market hours, they're only trading from the regular marketing hours from 9:30 to 4:30, right? Or 4. So tomorrow market opens and CPNG opens at, so right now it's at, what is the price? At 27.50, right? It opens at, by the time the options market open, it's opening at, say, $27, right? So which is away from the strike price, like it moved away from the strike price, right?
Right.
So that means the bid is going to go down.
Correct.
So nobody is going to buy it for 45 cents. They'll say that, oh, I can only, like, the price is, it's a lot more up. It needs to move now. So it's going to maybe sell at like 35 cents or 30 cents, right?
Mm-hmm.
My trade would never get executed, right?
Okay.
If I just leave it like that, right? I had to come in and adjust if I really want to take that money, right? So if the market opens and say it closed at 27.50 today, right? Even if it opens at 27.50 at the market price, it may not get executed because we lost some half a day today, right? Time-wise. So if it opens at say $28, right, by the market opening hours, so yeah, most likely it will be above 45 cents. So it will get executed, right?
Okay.
So that means I'm going to get that. Say, let's say in that case, I place like 55 cents as my limit price. Say it gets executed, right? So I'm getting $55 right away, because my strategy here is to not to make by doing a day trading on this call, right? Meaning if there is a move, I'm continuously watching and closing. So I'm kind of just leaving it, okay, just in case by next Thursday, if it goes to 30 to 50, go ahead and sell it. But otherwise, I'll just leave it and let it expire. And then again, I can write the new ones. But sometimes what I do is if there is a big move, like once it gets sold, like at least for last week, for example, it kind of went up and then it suddenly fell quite a bit, almost 10%, right? So you can always close it in those scenarios so that next up move, you can take advantage and write the options right away.
No, I still did not understand. You're saying you will get $50 premium, but what happens to the one contract or the 100 shares that you put it for selling? You're also going to get that $3,250 credited?
Yeah, so tomorrow I'm going to right away get $55, right?
Okay, okay.
And the option is expiring next Thursday, right?
Okay. No, option is expiring on November 19th, right?
Oh, sorry, November 19th in this case. Sorry, yeah. So it's expiring on November 19th, right? So on the expiry date, if the stock price is above 32.50 or 32.50, equal to or above 32.50, right? I wrote a contract saying that I'm going to sell you for 32.50 independent of what the price is. If it's at 32.50 or above, right?
Okay.
So so on November 19th, so you're going to sell pretty much that stock will get assigned to whoever bought the call, and you're going to get 30 to 50. Okay,
so if it is 35, even if it is 35, you will only get 30 to 50. But if it is, let's say if it is still 27 only, then what happens?
Then you get to keep that $50 premium.
And you are basically, it's not a sale. You're still making $50 out of it. That's it.
Yeah. So you made $50.
You're not losing anything. You're not.
That's correct. Right.
Okay, got it.
So effectively, you are reducing your. So some people view it as like I'm reducing my cost of ownership. Meaning earlier, if I bought it, like in my case, I bought it for $30, right? Close to $30, right? So by getting this $50, it's been almost 55 cents, right? So my cost of my stock went down by 55 cents, right? If it doesn't get executed.
Okay. So basically, the way you do it is you keep putting covered calls as in basically you took November 19, but let's say you keep buying covered calls every 2 weeks. So you keep reducing your cost of share that you bought.
Right. By getting so it's not buying, it's selling calls. Yeah.
Right. Yeah. Basically, you're reducing your actual cost by doing that.
Right. Okay. Sometimes, for example, Airbnb, right? So if you look at Airbnb does weeklies, right? And here you can see my cost is $173, right? So I can pretty much say for next week, I can actually write a covered call. I can get $1.32 for $175, right? Yeah, if it is above $175, I'm still selling it for $2 plus $1.32, right? $3 profit. If it doesn't hit $175 by then, I get to keep it. I can keep on doing that every week. So some stocks will have weeklies, some won't, right? They'll only have monthlies.
Got it. Okay.
So that's the cover call approach. I just want to show you guys one more approach that I use quite often. So I haven't done this in this account though. So for example, I have a CPNG, so many stock, right? 2000. I still want to say, I want to average my CPNG, right? So one way to do it would be like right now, yeah, it's less than what my cost share is. I can directly go and buy for 27.51. So that brings my average cost. What I do is, I don't want to go spend my money right now. I don't know about the market, might still go further, right? So what I do is I sell puts. So for example, let's look at the November one. So November $25 one, if I sell a put, I can get 85 cents. So that means I'm writing a contract saying that I'll buy the stock for $25, independent of the stock is at 25 or less. I'm always writing almost 10% away from the current market conditions, and I'm getting this premium of 85 cents. So that means my effective cost, if it goes below 25, would be $24.15. So here I'll be again doing a sell to open, one contract. So okay, 85 or 90, I'll just make it 87 because I don't want to be giving away for the price that people are asking for. Okay, this one is rejected. I need to check why. But anyway, so yeah, I don't have any cash available in this account because as you guys can see. But that's what I usually do when I have enough margin available or account the cash available.
Yeah, I think Abhi is clear. Let me take the next question. Ram.
Hey Asti, and thanks a lot team for arranging this. It's been a while, a lot of questions on this thing. Thanks for clarifying. The question what I have is, let's say the coupon, right? You told that if it hits 32.50, it gets sold. Now, let's say if I know that the stock next week or early next week it's going to 31, and I don't feel comfortable selling it at 32.50, can I just close that and keep the premium? Or what will happen to that?
So yeah, that's a very good question, right? So let's take this same example. I want to show you something. So these bid and ask prices are based on the current market conditions, right? Given that it's actually trading at 27.50, it's almost $5 away from the current price. So that's what we are getting, right? But let's take an example, right? If I want to trade a $30 call, which is only $2.50, you can see that whoever is buying this call, they're paying a lot more, right? Almost $1. So same scenario applies here. For example, we sold the covered call tomorrow and we are at $55, but suddenly it went to say $30 or $31, right? So, but if you think, oh, I don't want to lose the money, that the thing is, the value of the option is going to go up. It will be around $1.50. So if you want to close it, you have to actually pay $1.50 to close that. That means you're going to lose $1 on that trade. Unless you are pretty sure that it's going to go to like 35, 36 before that thing expires. Or there are other conditions, like maybe say you miss looking at the dividend, or suddenly then something is going to happen that's going to either pay a little more dividend or it's things like that. That's something I usually don't do.
Got it. Okay. So let's say if I use a margin account, okay, I get $55 credit into it. Now, what will happen to my margin account? Will any amount get locked or something? I have to pay for interest for it, or it doesn't matter?
So they do have some requirement like your account value, but so the way what I have seen it, the way it works is it again varies from broker to broker. So you got the $55, it gets applied to your cash, right? So your option value itself, for example, if suddenly it becomes $32 tomorrow, right? The option is going to get, say, $1.50. That means you have a paper loss of $100. So your overall account value should support that paper loss.
Okay. But once it reaches 30 to 50, automatically that 55 adjusting that, it's going to get sold off. Then I will not have any loss, right?
It won't automatically get sold. So the way the options work is, so if they're expiring in November 19, right? So if suddenly stock goes to 35, unless somebody executes that option saying that I want to go ahead and buy it now, it's going to show up as a loss on your option. So the way it works is your stock is going to still show as profit, right? Up to 35, whatever is the profit you have. But your option is going to negate that profit showing as a loss in your account. Say if somebody who actually bought that call, if they execute a call and your option gets assigned to that, then you're going to lose the stock right away. But otherwise, it will be there till the end of the expiry. So you'll have both your stock as well as a short option in your account. So one is showing your stock will be showing profit, and you'll have an equivalent amount of, because it's a deep in the money at that time, you'll have some the loss offsetting your profit. So your overall account value will be pretty much the same as at 32.5 for that particular stock.
Okay, got it. On that particular expiry date, if it didn't reach that amount and it doesn't get assigned, then I can keep it.
Yeah.
Correct?
So usually this platform, they say that it has to be at least 1 cent above that price. So if it closes at exactly at 32.5, usually they don't assign. They get expired or worthless the option. So you get to keep that 55. Okay. But I have seen some cases, even if it's like 3-4 cents, sometimes they don't get executed. But if it's anything above 10 cents, it will get executed.
And then I will lose that stock along with the premium.
No, you still have that premium, right? 50 cents.
Oh yeah, I have the premium, but the stock gets sold out. That's it. Okay.
Sold out at 32.50, independent of whether it's at 33 or 32.58, 50. Like it doesn't matter.
When should we use this? That's another biggest question, right? When should we use it, and what is the risk to this?
So the covered call strategy is always. So there are two ways. At least I use it, right? So one is. As soon as I buy the stock, I'm comfortable taking 5% profit in 1 month, right? Or I'm comfortable holding on to this stock. So I'm only doing this covered call approach with the stocks I'm comfortable holding, right? But or if I'm making just 10% in just next month, that's fine. I'm going to do it, right? So that's one case. Other case would be I have a lot of stock that I bought, say last year, and I already have a lot of gains in those stocks, right? Almost 50%, but now I'm not sure whether should I go ahead and sell it and book the profit, or I'll just start doing the options, covered call options, so that, okay, till the time that they get assigned, at least I can start making some money on those. So there are other variations of this covered calls where you sell the deep in the money things for various other scenarios. So I'm not going to get into that unless somebody has a specific question.
I think Ram is good. He got, looks like he muted, so he cannot unmute again. Next is Anand.
Hey, I had one question. So if I don't want to wait till the date of expiry, right? Mm-hmm. How can I make profits out of this?
Okay. If you don't want to wait till the expiry, and so this is a covered call.
Yeah.
Is based on the fact that the value of the option is going to increase if the stock price goes up, right? So if the stock price is stayed below the strike price, or if it stayed at 27.5 till say end of this month, the option price is going to go down to, let's say it goes down to 10 cents or 15 cents. Because as the time factor is a big thing in these option pricing. If there is no time value or less time value left in the option, and the probability of reaching the strike price is low, then the option value goes down, right? So in that case, if the value is staying at say 28 or 29, even 1 week or 2 weeks before the option expiry, so the value of this option will go down to, I would say, like 15 to 20 cents. So at that point, you can just close it for 20 cents. That means you're buying from the market for 20 cents. So your effective profit is 35 cents because you sold it for 55 and you bought it for 20 cents.
Okay. So you need to, when you did like your initial call, it is sell to open. So you have to do buy to open?
Buy to close.
Buy to close. Okay.
Yeah. So one of the options, I can quickly show that here. Okay. So here there is a sell to open, right? At least in American predicants, the buy to open, buy to close. So you can say buy to close. It's an opposite of sell to open.
Got it. Thank you.
Okay, I think that's all, Asti. Looks like no questions. I at least don't see anybody raising hand. If no questions, I think can end it.
Okay. Yeah. So if my suggestion for the newbies would be, just play with the covered calls and the secured puts. That's the best way to get in without too much expertise in the option. So once you get your feet wet and understand, okay, what are the maximum profit and maximum loss, then you can start combining the calls and the puts. So to understand what's the maximum risk and maximum profit, all this volatility, all these other things, how they factor into the pricing of the options.
Yeah. So, Hasti, one question is, if I go through the chart, how do you decide on the strike? For, let's say, even for this covered call or anything, based on your average, you decide it, or based on the current stock price and how far expiration you are picking?
Yeah, it's actually all the above.
Okay.
Yeah, the reason is sometimes, so in case of a coupon example, it's very close to what my purchase price is. So it's okay in that case, meaning I'm just doing it 30 to 50 ones, right? Okay. But there are cases where I have some stock where I lost like almost 40% on those, right? But I'm not comfortable just closing everything right away. So I do sell calls on those, but I'm not selling the calls that actually fetch me profit on the overall stock, but just the profit based on the current price. Means but overall stock, if it get assigned, I'll be losing the overall on the overall stock.
Okay.
That do happen sometimes. So, but sometimes you want to just get rid of the stock and just kind of start playing with the option till to the point that you're ready to get closed in.
Got it.
Yeah, in those cases, sometimes I do the deep in the money call so that I can get the money and use it for something else.
Okay. Yeah, thank you, Asai. Yeah, if no questions, we'll end it, guys. Otherwise, please raise your hand so that you can explain your question.
Alrighty.
Yeah,
No
I
questions?
think, Sharath has one question.
Okay.
Hello, can you hear me?
Yes. Yeah.
Yeah, I have a quick question on the covered call. So one thing is what I've discussed is last session you helped us to understand how to do the covered call and secured puts, and have taken those knowledge sessions and started implementing on nano dimension, and they've been working fine. So I've been trying to recycle them, sell to like doing the secured put when the premiums are going up, like when the market is going down, so you get more premium. So on the opposite side today, when the market was going up, so I did the covered call. So it's been working for one or two stocks. I just tried with like a small value, $5, $4 values, and it's good. So thanks for those inputs. My question is regarding the long leap covered call. For example, have some stocks. I know I bought it at higher price during the Feb before. So for example, Outster is one of my stock. I bought it as a SPAC. So right now I still own like 125 stocks. The current average is like 7.5. So if you do a long leap covered call, is there any advantage? Because I have already done it. For example, for 1 year in Jan 2023, I'm getting 150 premium. So I said, anyway, this is really good stock to hold. And when I see every other day, it fluctuates from $100 to $400. The bid and ask price goes up. So is there any specific strategy that you use for long leap covered calls, like a long covered call?
Just to be frank, I rarely do long leap calls actually. I do sell leap puts when the market goes down. So for your question, so when you say it goes up and down drastically, are you thinking about making the profit, like small profit that you're seeing in that, or?
So in this case, Hasti, so like my covered call, I got $110 premium, but the timeline is like 14 months from now. The reason I did it because I wanted to own the stock anyway. So I've been holding the stock for last 7 months and I gained nothing. So that was my thought process. Because if I see premiums for 15 days or 30 days or 3 months, they are very, very low. Like it's not even motivating to get in. Since because the stock is not moving and it needs a lot of catalysts to get there. And I've done my research. I know that I bought it at overpriced. So because of the SPAC and all that hustle which we had in the past. So I accepted that and averaged and I got it down to like a doable price. So when I've taken for 1 year, so that the same covered call cost is fluctuating. Like when I check my option in the morning, 9:30, it shows minus 250, minus 300. That means someone is willing to sell that 100 covered calls for 1 year as 300, but I bought it only for 100. So do you think if I sell it back, I mean, I've never done that the opposite reverse way, but this is what I've seen.
Yeah, so a couple of things, right? So most likely the one that you're maybe using doesn't have much volume, option volume.
That's right.
Right, so which means when you sold, even the open interest, I'm assuming it's very low, right? So in this case, what happens is people are just putting the prices in there, meaning it's not real. It's still real, but it's not, the volume is low, even the underlying stock. There are not many buyers and sellers, right? So it cannot be, it's like just people are just putting prices and to see if they can get it for cheap, right? And even
I see.
You
okay.
can
Yeah, I agree with you because the bid and ask price, it's almost like $150, $180 difference. So that's when I thought whether I did it wrong, because every day I see the same consistency like 250. So I was just trying to get your experience on that, whether you do like a year old, because all these things that I'm doing is the ones that I got it at higher price. Anyways, I've been holding for past 10 months. I didn't make anything, but I'm just getting like $100, $120 on the 100 for like 6 months and just try to average further down. So that was my simple thought process because it was working on short calls.
Yeah. If the bid and ask spread is too high, that means usually you can immediately right away tell that it's not a high volume stock or a popular stock. So.
Got you. The next question is for the covered calls. Is there any specific strategy? Because I know you have been doing a coupon, Airbnb, and the one's good. So do you depend on the bid and ask price or the volume? So sometimes I'm confused, like which ones shall I pick? For example, the other day, one of our member in ThinkSabio group, he posted ENG. That was really good one because when I checked the chart, it was actually maintaining 2.5. He sold the call and then immediately we got $50. That was only hardly for 30 days. So I'm still trying to develop a screening strategy on how to do this because the implied volatility changes. And I'm not sure at what price ranges shall I pick up. So if I even have $5,000 cash in the bank or I mean in the account, so what kind of stocks would be favorable for this? Not MEM, but I'm just trying to see your thought process behind it.
Yeah, so I don't, I used to use a lot of technicals in the past. Now I don't look at like what's the volume and all the other factors much anymore. So I'm just trying to keep it simple. So my strategy is pretty simple, meaning stock has to have at least decent volume, right?
Okay.
And then the bid and spread between even the underlying stock should have the bid and spread pretty narrow, like 1 or 2 cents. And even the option should have a spread not more than 5 to 6 cents.
I see. Okay.
So you can right away tell, like, if you just look at those, I'm just looking for something that is tradable quickly. Like if I want, for example, for any reason, if I want to close something, right? If the bid and ask is too much, then I can't really sell unless I take a huge loss on it, right?
Yeah, I completely agree because there are a lot of people who wanted to exchange either buying or selling. So that works very effective. Yeah, I understand. So I just need to work on that because I'm trying to make a screener and see, just get used to it so that I can constantly watch. But I'm trying to follow like rinse and repeat, like coupon is the best one since we know a lot of stuff and I'm willing to hold the stock. So that's the best one. I'm doing it. Yeah. Thanks, Asti.
Yeah, sure.
Yeah, thank you, Asti. I think we are good here. One last question. If we do this, right, let's say stock price moves more than our by the end of our expiry. So we have a chance of losing all the stock, right? That 100 stock.
Yes. Yeah.
Okay. That's the risk we have. Okay.
Yeah. So that's why we try to put the strike price above your cost.
Correct.
So that's the hope, many most of the time, so that you're not losing money on that trade, right? You are making some, but may not be much. You might be losing some upside just in case it moves.
It moves crazily. Yeah. That's the risk. Otherwise, in the meantime, you keep getting. If they go worthless, that's the best thing. You keep collecting the premium. Right.
Yeah, that's correct. Yeah. So most of the trades I don't just do the options in the sense like speculating the market. I do it based on the underlying covered call approach, where I just said that, for example, recent trade I did was Delta, right? So I said, okay, I'm going to just buy Delta at 40 and I'm going to sell it at 42. So I did the covered call trade and then I got exited. But that's fine. I made my money within 2 weeks. It was the weekly trade. It went up to 45. If I had known that, I would have made a lot more money, but that's fine.
Yeah. I mean, that's the risk. Okay. Yeah.
All right.
Yes, Asti. Thank you so much for your time and everything. Definitely, if you go, I know you did not go through the chart. Most of them are happy for covering the topics. They like the session, everything. Appreciation is there. We recorded the session as well. We'll share it to ThinkSabio and they'll take care. But thank you. I think we are good here.
Thank you all.
Thank you all.